right, it is always a great day to be back with the Cashflow Chronicles team, the Money Gang. Hopefully, you guys are having a good one. Apologies for the, I guess, lack of episodes. Chris had some family things, and then I went on vacation. You can probably tell my nose a little burnt. But Chris will be joining us 5-10 minutes from now. He just noted to me via WhatsApp that he will be here. Just give him some time. But nevertheless, we are here to hang out and chat with you guys. I think what I will do a little bit of a monologue here, and then to do some Q&A until Mr. Patel shows up. But really excited to hang out with you guys, and as always, spend a nice Tuesday evening with you. It is not August 22nd. It is September 3rd. Let me change this really quick. So it is September 3rd, 2024, actually. And historically a bad month, as you probably, for those of you that have followed Amit and the morning open, generally September is a pretty tough month. So hopefully we'll be able to persist through that. However, off to a bad start this week. Apple 220, Amazon down at 175, the Bros hanging out just under $31. Google back into the 150s. So if anybody's looking for that, Palantir is actually below $30 in overnight trading, just over $550 for the SPY. Bitcoin took a little bit of a tumble, 57,000. Oil, as we predicted, below $70 as of overnight trading for the October futures. And I think it was just above $2 for natural gas. Henry Hub, meaning natural gas, and then Dutch is about $12. Japan, it's about $14. Maybe I swapped those. I'm not exactly too sure, but if anybody is actually paying attention to that. So I think with this, you're going to continue to hear more. Last month, I started a pretty decent bet that oil will continue to take a tumble over the next few months up to a year. And I think you're going to hear more of that in September, and why. So if anybody had the opportunity to read the OPEC Plus notes coming out of the June-July meeting for OPEC, they basically have two things in particular that I want you to be aware of. So they have a 3 million barrel, I don't know why I have this out. We have a 3 million barrel basically involuntary cut. So everybody is actually having to cut 3 million barrels. Obviously, some people are cutting a couple 100,000. Some people are cutting more than that. But overall, throughout OPEC, it's a 3 million barrel cut. Then there's an additional 2.2 million barrel voluntary cut, and that was extended until the end of September. So beginning in October up until the end of next year, there will be continued ramp ups that the folks that have taken the voluntary cuts will be able to take advantage of that. Why is that important? Well, oil prices are pretty much already well in balanced, or oil market is pretty much already well in balanced. The United States is at all-time highs in oil production. Guyana continues to ramp up. Brazil continues to do extremely well. We continue to find more oil off the coast of Namibia. And everybody just keeps investing, right? And I don't necessarily see a slowdown. So even though you've had a lot of CapEx go towards buybacks rather than actually reinvesting back into the oil companies themselves and their products and their fields, unfortunately, there's just a lot of Middle Eastern oil out there that, you know, is continuing to be made. And why is that important to acknowledge? You know, I don't think, and we've talked about this in the past many a times, but maybe not necessarily on Cashflow Chronicles, a lot of these oil companies in the Middle East, and more so specifically the countries in the Middle East, are welfare states. So generally the majority of their money comes from selling oil and gas. Depending on what nation you are, some people are more dependent on the gas production, some people are more dependent on the oil production. But a lot of those guys, and this is a very general term, but a lot of those guys, and meaning countries, break even about $80 a barrel. So if you're breaking even at $80 a barrel, technically you're already losing money, because we're now trading at Brent below $80 a barrel. It's at $73.35 right now. West Texas Intermediate just below 70. What's the other way that you will be able to break even? So to be able to offset that $80 a barrel, you can produce more oil. Now, obviously, that produces another strain on the actual market itself, because not everyone can just raise production, because then you'll have a supply demand imbalance and it's only going to exacerbate the problem. So you're going to have some real issues in the next 12 months as to who's going to balk first, right? Is the price actually going to dip into the low 60s, high 50s, and people are actually going to start to choke back to be able to get the supply demand balance back in order, which happened back in 2014, 2015 timeframe, which was when we saw oil go from like $80, $85 for WTI down to the $30 range. So is that going to repeat itself, or are people going to actually come and play ball, right? And in the December OPEC meeting, they'll potentially extend those voluntary cuts. And I think that that's really what you're going to be hearing about with respect to OPEC specifically. But a lot of that is on the backdrop of really this softening of the economies globally, right? So China's obviously doing very poorly. We'll probably ask Chris, because he probably knows a little bit more about that. But you have a lot of economies softening around the world. You're seeing economic data starting to show that things are starting to slow down, even though we just had 3% GDP growth in the last quarter. We're starting to see jobless claims increase. We're starting to see other economies really starting to struggle, which is why some of these economies are actually starting to cut interest rates already. So if you think about it in that perspective, that means that people are starting to see slowing. And if you are on the backdrop of a recession, you already have oversupply. The demand is strong at over 100 million barrels, but at the same time, the supply is just way up there, right? So even though you have a big supply, big demand, if you have an oversupply of it, you're just unfortunately going to be in a massive imbalance. So that's currently the state of the oil markets. Now, I don't necessarily know what's going to happen, how aggressively these guys are going to push. I do know there's several countries looking to increase production very quickly. Libya was one, and obviously that is going under some geopolitical turmoil right now. And then obviously you have the UAE and several others that are also trying to increase production. And so once a lot of these voluntary production cuts kind of roll off at the end of September, you're going to be kind of in no man's land for October, November until mid-December in that OPEC meeting. So I'm sure that's going to be a continued conversation. And I feel like unless there's an emergency OPEC meeting, you'll continue to see oil prices be very volatile from here. So keep in mind, I mostly look after WTI because I work in the US, and the majority of the US works off of WTI, which is West Texas Intermediate. It's the sweet or very low sulfur type of oil. And then you have Brent, which is a little bit different of a grade. And that's mostly coming from the sort of the Europe area. So there's a bunch of different types of crudes and different grades and everything of the like, but those are the two that I mostly keep track of, WTI being the one that I'm most concerned about because that's what majority of pays UDOC's bills is Gulf of Mexico, but there's other things in there as well. So anyway, let me go through the Q&A, and then hopefully Mr. Patel will be joining us. But before that, we have a message from our sponsors. Just kidding.
Greed is good.
The stock is going to go up, down, sideways, or in fucking circles. It's all a fugazi.
Sell it all.
Greed is good.
Huge upside potential, upwards of $60,000.
All right, so very happy that you guys are here. Very much appreciated. It's always fun. We can get 50 or 60 of you guys on very rapidly, and I know the numbers will only climb when we get Mr. Patel on. So let me just read through some of the questions on here. Zscaler, I don't really have an opinion on. I just briefly looked at it. It doesn't make any money at the moment, so I would have to do some more due diligence, to be honest. It could be that Robinhood is wrong on that one. It might have a positive earnings growth. You never know. Wong, what's going on, my guy? When Jet, Rob? I agree with you, man. When is Jet? Blackbeard, what's going on? What happened? What's happening? What happenings? Good question, Tuan. Very good question. Miss June, hopefully you're getting everything that you want and more. Yeah, we need to ignore the rest of our life. Well, we would if more people would watch. So if any of you guys are watching, you get a lot of value out of this channel, especially that nice little like 8-minute monologue about oil, and you thought that that was important, or somebody that would be interested, send that to them, and hopefully they get some value, and hopefully they can subscribe, and we can continue to grow. It's hopefully a stepping off point for me and Mr. Patel. Willie, what's going on? Thank you for your continued support. Dragon, what's going on, my guy? Yeah, I appreciate it. I know I wanted to do a stream before I left, but Chris and I just couldn't make it work. Dean Pierce, what's going on? NVIDIA, yeah, I have to call Steve and give him an earful. What's going on with that? But I did see that they are potentially subpoenaing NVIDIA with respect to it being a monopoly. So maybe Mr. Patel, I know he'll have a very big opinion because Mr. Patel is what we call the community bear on all of AI. He thinks it's going to zero. And so we'll probably get him to ask that question. Why are they cutting? You mean with respect to the oil prices? They're cutting oil price or oil supply because, they're cutting and holding back and curtailing production because there's just too much. So $70 for oil, you think they will refill the oil reserve? That's between I don't know, Mr. Biden and the Lord. I don't know. 65 level, huh? Anyway, Mr. Patel, what's going on, my friend? You're on mute, my guy.
We got caught off sides, man. We got caught off sides. We got a little greedy. And we got caught off sides. Basically, our TNA position is probably not doing too well these days.
That happens, man.
How much do we have in TNA? What's the portfolio look like today? I mean, I think we're fine because I think most of our stuff is pretty good, but just want to make sure that we're not. I want to keep outperforming the S&P, so we got to make sure we're adjusting our risk to better align with that.
We are.
While you do that, I am going to pull up some data for us, which I thought was very, very interesting. But
we have 16 and a half shares, so $600 in TNA. Not so much.
So not that much. Okay, it's
probably
probably
it was 750, but it was 740 rather. But it's
yeah. See, this is the problem with doing leverage plays sometimes that are like market direction focused.
This is the problem, though, is that you look at it day by day. And, I don't know why you get so freaked out. Sometimes time heals all wounds, Mr. Patel. Sometimes I have to let you know.
That's true. No, the reason why I'm saying it is because one of the things that we want to do is when it comes to risk. Like I think one of the great things about our portfolio is that we've been efficient at risk management, making sure that we're not overexposing ourselves to any one particular part of the market. Like when we had that opportunity, when the market got sold off on NASDAQ, we bought a ton of TQQQ and then we sold at the right time, So usually what happens is these opportunities come and then they kind of like go away very quickly. And the thing is, you don't want to like maintain a leveraged position for too long. And then, basically now you're dealing with the recovery. And the thing is, in order to recover that, you have to, go into more speculative things to break even, And so I'm not the biggest fan of that, but
Yeah. Well, I did want to get your thoughts because you are the master bull of master bear, of AI. And NVIDIA took a little bit of a dump today. Do you have any insights on the subpoena that they got?
Not really. I mean, that's not the bear case for NVIDIA anyway. Like, if anyone told you like, oh yeah, they were able to predict when Nvidia was going to get slapped by the Justice Department. Like,
Oh
no
no,
one knew
that was never the
Yeah.
the thought for you.
Yeah, and that's the worst reason I think that we're likely to see anything negative happen to Nvidia, because Nvidia clearly, in my opinion, has not shown itself to be a monopolist company. You know, they've pretty much had, okay, our technology is the best one. We have a moat around our technology, which is hard to replicate, and that's it. You know, now is it their fault that they've been so successful? No, of course not. It's just sometimes that's how things work. I wonder how much of this is political, though, you know, which, believe it or not, this is why we have to talk about politics sometimes. Even if we don't particularly agree with it, we don't like talking about it because, like, you know, like, oh, politics hurts my thinking. Like, I don't want to be political. Like, yeah, well, unfortunately, government and business go hand in hand. So yeah, like, just right now, this could be some political posturing by the current incumbents and saying, you know what, we are going to take a stand against monopolies. Like, we're for the little guy. You know, Nvidia is being a monopoly. So I don't know if the DOJ really has any teeth behind what they're doing, but you know, a lot of this stuff is just very, very political. You know, and it's, I don't know what's going to happen, but that's still a risk. I think the bigger risk for Nvidia is just a slowdown in AI spending in the coming years, in which case now the growth rate might have been brought forward a lot. And in which case, if you look at something like, you remember Celsius, like
Mhm.
after the deal with Pepsi, you had a huge ramp up in inventory, right, from Pepsi, and then it kind of just fell off. And it's not that the demand isn't there. I still see people drinking Celsius all the time, like everywhere. But the thing is that channel inventory, that initial boost was so high, everyone bought the stock thinking, and no one sold at the top. You know, and then when now they're holding and they're basically bag holding the damn thing. So
Mhm.
it's kind of like that with Nvidia, in my opinion, where a lot of the demand was in the future. And now it's not that like people are not utilizing their GPUs, it's just the growth rate in GPU utilization. I think next year is going to be flat to maybe like a little bit more than what we're looking at. So maybe like conservatively, I would say 15% growth, optimistically 25% growth in GPU utilization, right? So I mean, not GPU utilization, GPU sales for data centers. And that's still a huge amount. Like, a lot of people don't realize you're talking about going from what was let's take a look at their thing. But damn it, man, I got to talk about credit too. I don't want to keep opening new windows, but
What do you want me to pull up? Sorry.
I'll pull it up.
Yeah.
Let me just show you.
But I think I do want to, because there, if anybody isn't bag holding, I mean, there is with some of the things that we've seen pull back. I do think that there's an opportunity. Obviously, you know, I'm not talking about the pullback today, but there's still some companies out there that have pulled back recently. Celsius being one of them. And if people haven't initiated a position, honestly, I think it's probably an okay opportunity here.
It's starting to get there. It really is starting
Yeah.
to get there again. But what we need to see with Celsius is stabilization of its growth, right? You want, so some people say like, oh, they want growth, growth, growth. Like, I'm more happy with a company that does 15% CAGR for the next 5 years rather than 1 year they grow by 50% and the next 5 years they grow by 5%. You
Right.
know, because what ends up happening is the market front runs that 50% growth, thinking that that's what's going to happen for the rest of the time. In which case, if it doesn't happen, you know, the next few quarters, everything gets sold off. So this is Nvidia's like current projections, right? Like by multiple analysts. So 58 analysts are saying 2024, you're going to get a total of $2.79 of earnings, but the revenue is going to grow by about 102%. Next year, their growth estimates that it's going to be almost 40% year over year in total revenue, right? So, in my opinion, this expectation is kind of lofty.
Yeah.
You know, now they may be seeing something that, you know, that's out there, but as far as I can tell, I don't think that they'll hit this 40%, almost 40% growth rate. I think it's going to be closer to maybe, you know, 25, in which case now all these other estimates that are going to come down lower. So it's just going to be harder for Nvidia to meet this thing. And especially if we do get a recession, a lot of companies, they don't have, like, if they don't have the capital to spend, you're going to see this come down. And then when it does come down, you're going to start to see Nvidia coming down as well. So you can see right now, if you're buying Nvidia, even today, you're buying it at a forward PE of about 27.9, which is not bad. But then if you think about like semiconductors, they usually are between 15 and 20, with 20 being like, hey, you're growing exponentially, like really fast. But we'll see what happens.
Do you think that that's just an AI slowdown, or do you think that that is other competitors starting to come where people are willing to pay cheaper prices? Because I know Nvidia is charging, right? I mean, they're not giving these things away. So do you think it's the fact that other competitors will come to the space and charge a better, say, margin for the consumer, and so people are more likely to, instead of go to the H100s or H200s, go to their product because it's $10,000, $20,000 cheaper? Because I mean, we're talking chips that are costing 50 grand. I mean, we're not talking things that are cheap, right? So I guess that's my question. Or do you think it's a lot of people going the way of what like Apple does, which is saying we're going to make our chips ourselves, right? And I know that Tesla is eventually going to do that, and X is starting to do that. But I don't know. I'm just kind of curious from your thoughts as to, is it a combination of all three of those things?
I don't know, man. I think it's going to be probably more on the latter thing that you just said, which is the combination of things. But when I look at this, like I'm trying to assess like why some of these people have some of this stuff. Like this is like the growth rate on a quarterly basis. So according to the analysts, in next quarter they're going to grow about 51% compared to last year, which if you look on a quarterly basis is only about $3.3 billion more, right? So that means that if you look over here in 2025, that means that the growth rate is going to go down to 20%. But what does that mean? That means that it's gonna, let me see, from a total perspective, 10. So it's gonna go from 33 billion to 40 billion. Like, does that make sense? That there's gonna be, like, it went from 30 to 33 in this quarter, but then next year it's gonna reaccelerate almost $7 billion more. Like, I don't believe this. Like, I don't think this is gonna be the case. $7 billion.
So let's ask a different question, right? I mean, I think we've talked through, I understand where you're coming from, and I think that there is a possibility of that. I guess my question is, Nvidia is here to stay, right? I mean, is it going to be a company that is actually worth $3 trillion, or what would be a price that actually entices Chris Patel to get involved? I mean, in thinking about where you actually think that those earnings are going to grow, I mean, they might not get to the 387 that you're showing there, but do they get to $3.25 or $3? And if that's the case, I mean, at a $105 stock price, when you're talking about a 325, you're talking about a 32 price to earnings. It's not too different than what we're seeing for Apple and some of these other companies. So I guess my question is for you, when do you actually get kind of fired up? It's not going to be the 387, right? We know we're probably going to underperform that based off of your thought process. And if it is that 387, we're talking about a next year price to earnings of 27, right? Which in all case at today's price, at the closing price of 105 after hours, right? Not that 108, but that 105. That's a 27 price to earnings for fiscal year 2025. That's not bad compared to the rest of the Magnificent Seven. So my question to you is like, okay, so we're not hitting that 387. So what are we going to hit? And then what do you
I'll be honest, I'd rather buy the cruise lines, dude. I'd rather buy Carnival and I'd rather buy Norwegian than Nvidia, So, like, remember, if you're going to lock capital away into a business,
we're not going on a cruise line conversation again, by the way. I'm not.
I'm just saying that you're seeing that there's actually better growth rates in this part of the market than there are with just Nvidia. I think the Nvidia, there's a lot of risk, and unless Nvidia really goes down substantially, I don't think it's worth it. And especially because if the AI trend slows down, That's going to be really bad. And I like I said, I don't see any killer apps or killer products that are like, oh my god, we need AI, in order to like just say to myself like, yeah, this is where I want to be. Like maybe there's an app that comes out, or maybe something like happens on the phone, which is like, oh my god, I definitely need to upgrade now, and we need all the latest models. Like it just, I don't see it, And if I don't see it, I have to.
What would be a reasonable valuation that you see trading on fiscal year 26 earnings or 25 earnings? Is it like 25x?
It would
Is
be
it
20. It'd be at least 20. Like I think 20 is good enough of a risk, even though that's on the high side of like the valuation standpoint for semiconductors themselves. But 20 would work for me, And what I mean by 20, I mean 20 on a forward basis. But then again, I
Yeah.
don't trust the forward basis. Like a lot of these analysts, they're putting up some really, really rosy numbers. So
Yeah.
I just don't trust it. Like no one, like all of the analysts that are on there, they're all different. They're all different, up, down, left, right. So the key is like, who do you believe? There are some analysts that are saying, no, there's going to be a sharp decline in GPU demand. Who knows? No one can really tell you what's going to happen. I mean, you remember in 2021, like everyone was like, oh my God, crypto is going to be here forever. Everyone buy Nvidia because they make the GPUs that do the mining for crypto. And then crypto fell off. There were some changes in crypto. And then what happened to demand for Nvidia GPUs? They went down, right? So it's very hard to tell people during an upward, quote unquote, bull market that they're in a bubble. Like they'll literally like they'll come after you. And I've had people come after me, dude. Literally,
Yeah.
if you look at Amit's stream, a couple in the morning, I mean, dude, people got really fucking nasty.
I don't disagree. I mean, it's uncharted territory, right? I mean, to consider something, one, increasing 100% year over year from fiscal year 23, and then another 40% on top of that, that's insanity, right? And a lot of times you don't see that unless you're talking about a brand new company, right? And we're talking about a company that's decades old at this point. So to me, I mean, what do you think is more reasonable for next year? 25% growth? Like that, because that gets you more to like the 340 earnings per share. So in that respect, it's taking that thought that you had, 347 in terms of
but then
EPS.
also, Matt, then there's a couple of other things to remember too. So right now, Nvidia has a buyback program. So how much of that buyback program and how effective is it going to be at boosting that EPS number? So like right now, they've authorized 50 billion in buybacks. So if they bought back at 130 versus they bought back at 70, it's a big difference on their EPS on a forward basis, right? So there's a lot to do. I mean, it's the best you're going to do is come with a range, right? Where 60, in my opinion, would be like, oh my God, like this is the opportunity to buy no matter what. And then I guess like 70 to 80 would be like, hey, I'm going to buy, but that's like more fair market. And I think anything above like 90 is like, hey, you're taking on a lot of risk for, substantially
growth that might not show up.
Right.
Yeah.
Exactly.
Or it'll take longer. And in that respect, then you're paying for years ahead that, you're paying for fiscal year 27 or 28 earnings and not fiscal year 25 or 26.
And you would basically underperform the market while waiting, basically.
Yeah, but that is, I guess, a good question. I mean, I don't know. They're not making enough right now. At least I don't think. Maybe I could be wrong here. That 50 billion is that even sustainable in terms of buybacks on an annual basis? I mean, I guess it is. If they're 2.66.
That's the one thing that they do not have a problem with. They're generating cash like there is no tomorrow, dude. Like, let me just pull it up real quick.
I guess they're making at the moment like about 50 billion in cash. So that's a good question because that reduces, I mean, at the current 2.5 trillion market cap, that reduces the float 2%. So if they're able to reduce the float, I mean, we have this conversation about Google all the time, right? Google, from that steady $75 billion of buybacks they've been doing every year, is massive in terms of putting a tailwind on the EPS.
Yeah.
and really
So
alleviating a lot of that.
So look at this on a free cash flow basis right now on a
Yeah.
TTM. They're not free cash, right? Operating cash. They're generating almost 48 billion in operating cash per year right now. That is
Yeah.
freaking massive, you know. So it's not that this company's not generating good money. And I mean, if you look on a last quarter, how much did they do last quarter? Look at that. Operating cash flow actually went down a little bit. It went from
Mhm.
15 to 14. I mean, maybe they had some one-time expenses that came up, but you know, this is still a pretty healthy number, you know. So yeah, I mean, and look at this. They bought back
10
how much
billion.
did they bought back?
Oh no, that was something else.
Repurchase of common. So yeah, they did 10 billion and then they did another 8.7 billion. So you can
Oh,
see here just for this year, they bought back 3, 4, 3, 9, and 8. So let me see how much it is on a TTM. I mean, they bought back almost 26 billion. And look at this acceleration in
so that's
buyback.
1%. Yeah, it's 1% of the float.
See, but the one thing is all of this money, like the buybacks that they did early on, these have much higher ROIs because they were done
Mhm.
at a much bigger, like a much bigger discount. Like now, if they do buybacks at today's prices, it's not gonna be as impactful. So this is where I would say like maybe they need to hoard the cash on their balance sheet a little bit, which they're probably doing because they do have about 26 billion in short-term
Mhm.
treasuries, probably about 34 billion in cash. So if the stock goes down enough, they could deploy this and boost the share price and keep it, you know, keep it elevated and be a very opportunistic with their buyback, you know.
Yeah. That's an
So
interesting one. Yeah, it's an
yeah.
interesting one.
This is where a
Um,
good this is where like you need to be a good CFO. Like if you have a good CFO, they're worth their weight in gold because they'll
yeah.
know when to start buying back. They'll know like, okay, next quarter is going to be this. So let's wait, you know, instead of trying to deploy it too early, in which case now the stock drops, you know, 20, 30% and you basically used up that extra cash, you know?
Yeah. I did want to answer this with respect to somebody asking, because before you came on, Chris, I was kind of giving everyone the insight about West Texas Intermediate dropped below $70 a barrel. So we're now in the $60 range. Brent is below $74. So, I've been preaching, that I think it's going to continue to worsen. And I think now it's coming into light because we're in September and the voluntary cuts for OPEC really start to come off of uh, the, I guess, cuts or supply constraints at the end of the month and basically go for free up until mid-December when they have the next OPEC Plus meeting. But to answer this, that's why there is a problem. This is why OPEC is trying to control it primordial light. So the countries themselves, like OPEC, Saudi Arabia, UAE, all those, like Russia, all those countries, the ones that are part of OPEC are the ones that are trying to reduce the supply to be able to up the price of what they're selling. That's part of the problem, is because you don't have Exxon, Shell, Chevron being like, oh, let's curtail the production tap. And that's part of the problem that is being exacerbated, right? As I said, you have the United States producing 13 million barrels plus a day. That is at the highest that it's been prior to the pandemic. It was like 12.5 million a day. So now we're kind of at the peak, if not slightly higher than where we were before. You have Guyana, which came on. It's a brand new region that was never producing oil before. You have Brazil, which is ramping up production. So all these countries that are not part of OPEC continue to increase production. So those are the countries that are international oil companies, not nationally owned oil companies, right? There's two disparate sort of, or two distinguishments I want to make. International oil companies are the companies that you talk about, like Shell, Chevron, Exxon, etc. Then you have the nationally owned oil companies like Saudi Arabia. Those are generally the ones that, or Saudi Aramco rather, those are the ones that are basically the ones that are going to the OPEC meetings. Exxon doesn't get involved in OPEC. And a lot of these other countries that are really starting to ramp up production don't get involved in OPEC either. And that's part of the reason why there's so much discussion because they're trying to maintain basically control of the market, and at the same time they can't because you have other people that are independent of them that are making oil and gas, and unfortunately that leads to what we have, which is this volatility in the market. And so I'm anticipating oil prices go down to $50. So we'll see what ends up happening with that. Sorry, Chris, I didn't mean to
No,
cut
it's
you
all
off.
good.
Yeah.
Dude, oil going down to 50 would be huge for disinflation and maybe even deflation. Because
Yeah.
I mean, people really underestimate how much of a carbon economy we really are. Like every single company on the planet has some level of influence by oil. Whether you're even a agricultural company with farming, like industrial farming, you're utilizing fuel. You know, you're transporting logistics from one place to another. You're using fuel, plastics. You know, every single part of the economy runs on hydrocarbons. You know, even if it's not directly, it's going to be indirectly. So a drop in oil prices is actually very bullish for a lot of companies and their margins, but at the same time, it's also very disinflationary. So right now with the federal funds rate, and this is where I love the bond market, because the bond market, unlike the stock market, is more like of a it's more of a like a crystal ball in predicting where we're gonna where we're gonna go with regards to inflation. So let me just share this screen. I thought this was actually very interesting that no one seems to be really talking much about.
Well, while you bring that up, I did want
Yeah.
to. I'm not going to spoil it for anybody. For those that are Patreon members and haven't listened to Chris's conversation with Sam yesterday, I thought it was really intriguing. The stuff that you guys were talking about with mortgage companies, and it actually makes me want to bring up a company to you after, which might be one that I'm curious to see what your thoughts are. It's getting to the place where it's profitable, but I think it's in that same sphere of mortgages. And so anyway, for those people that are interested in that, Chris and Sam talked through a few companies, and I thought it was a very interesting conversation. So I wanted to relay that, and especially for the Patreon members listening on Chris's Patreon, be sure to watch that because it was really cool. I didn't listen to all of it, and I didn't finish the pod from yesterday, but I thought it was really interesting. So
Yeah, we'll take a look. This is something that a lot of people really need to pay attention to, but it's not getting a lot of attention. Um, this right here is corporate debt and also SOFR or SOFR. SOFR is what adjustable rate mortgages are based on. So basically, if you have an adjustable rate mortgage, I mean, not mortgage, sorry, adjustable rate debt, what ends up happening is there's the SOFR rate plus the interest on top of it that you would essentially have to pay. So if you have SOFR plus 2, that means that you're going to be paying whatever the current SOFR rate is plus 200 basis points on top of that. And that is what your effective yield is going to be. Now, one of the things that's really interesting is if we're looking at this with triple Bs, double Bs, and SOFR, you're actually seeing triple B, which is investment grade, but it's not like super, secure investment grade. It's actually trading below the 30-day SOFR. And what's interesting is if you add one more line, which is, and the SOFR tracks the Fed funds rate. So let me just put that up there. Federal effective rate. So you can see here this purple line. The purple line is the Federal Reserve, Fed funds rate. So you can see how the Fed funds rate went up. SOFR followed suit, and eventually it got to the point where they're kind of like flattened out together. Now, what's very interesting, Matt, is that I looked in the last, probably like 30, 40 years, because that's when they started tracking this stuff. There has never been a time where the corporate bond yields on the triple Bs have actually been lower than the current federal funds rate, which is kind of crazy because that means that people are buying up this corporate debt at a really fast pace to the point where they're kind of like predicting future rate cuts are going to be steep as hell. you know,
Yeah.
and I'm kind of in the I'm kind of in the boat that that's exactly what's going to happen. So, and it's interesting because now, whereas before it was like, okay, the investment grade, at least it's, you know, it's coming down, it's not that bad, but high yield, the spread on high yield versus the federal funds rate is like the narrowest that it's ever been, that I've ever seen it. You know, then again, I haven't been in the market like, you know, like forever, but you can see here the the high yield or junk bond rate should never be as close to the current Fed funds rate as we're seeing today, because essentially from a risk perspective, you're taking on more risk by being in speculative grade bonds. So it's better to keep your money in the federal funds rate unless you think, and the bond market thinks, that the federal funds rate is going to go down significantly. And
Mm.
that's exactly what we're seeing right now, where people are just bidding up this corporate debt. And actually, this is where the real opportunity is for people like us, to basically look at other asset classes that haven't necessarily gone down significantly yet. And you're able to kind of buy them up right now and lock in that juicy yield for a pretty good time, in which case now that asset class is going to go up significantly. So there are some preferred equity that are trading, you know, way below par, that I think are worth taking a look at. But then also there's equity, like there's actual equity, like private equity that's out there that's at the current yield. It's doing about 8% on the face value of the coupon, but it's trading at par value, which means, and it's a qualified interest payment. Have you ever bought into preferred equities, by the way? I forgot to ask.
Other than preferred equities, other than BPYPM and stuff like that, which is somewhat different, but I've never bought into preferred equities. No.
I'll give you one that I've been looking at. I have like a whole list that I've created, like specifically
Yeah, I've
for
looked at a lot of preferred shares, and none of them I've ever, that other than the recent ones that we've talked about. I haven't seen any that I've been
let
really.
me let me show you a couple that have just come out. Okay, let me see. Ugh, damn it, where the hell is it? Give me 1 second, because I have it open on a spreadsheet. So let me just.
No worries. So I think what the thing that I think is interesting, though, thinking about that is, do you foresee it being cut quickly because of what always ends up happening, and we end up entering some sort of recession, and you feel like they're going to use that to their advantage to kind of stop the bleed, like we have for the past early 2000s, and then obviously what we did for the pandemic, and then obviously what we did for the great financial crisis? Or do you actually foresee it being cut because the Fed actually cuts it and actually wants to be kind of hawkish on the cutting, um, rather than, I guess, how we have? Because generally speaking, I would say I'm I've come to realize that the Fed is generally slower than I would want on things like cuts. They were much faster on things like the raises. Anyway.
I'm not sure what you were asking. Sorry, I was lost in the train of thought. Sorry.
No, you're good. I was wondering if you actually think, because you were basically saying that the triple Bs are being bought up because that they foresee that money is going into that, because they're not going to be able to attain, let's say, cheap money through savings accounts and everything
Yeah,
like that. Because
they're trying to
they
lock
think
in.
there's,
The thing with
yeah.
bonds is that with bonds, especially long duration corporate bonds, you're able to lock in
Yes, yeah.
that,
So let me
that
finish. So the reason why I'm asking that is, do you think that the Fed is actually going to cut it way faster because of an upcoming recession? Like, and that's what we ended up seeing in the early 2000s, 2008, the pandemic, where we ended up cutting things to zero because of what the economic, I guess, foreground was telling us? Or do you think it's actually they're just going to be super hawkish and cutting it by, let's just say, one whole base or 100 basis points and then kind of waiting and seeing to see what the reaction is, I guess, between now and the first half of 2025?
I think it's probably going to be because like the CPI numbers are going to be extremely, extremely low. Like it's going to go to like maybe 0%, which is like not good. Like you need it, you need some level of inflation. Like 2% inflation is the target, but I actually can see a scenario where inflation gets below 2, in which case the Fed is like now trying to kind of stimulate their way a little bit going forward. Because I mean, if you look at, I told you there's three or four factors that are going to be very disinflationary going forward. Number
Mhm.
one, you've got this demographic issue. Like population growth is declining really significantly. If it wasn't for all the migration, like our actual replacement levels would not be that great, and we'd have like a Japan-like scenario. So that's number one. Number two, you got technology. So technology boosts productivity, but at the same time, it does it with labor that's actually like stays kind of steady. You know, so right now, like labor cost of labor stays the same, but productivity goes up. So that's naturally disinflationary because if you think about how much effort goes into producing a good and service, if you're able to kind of like produce that good or service, you know, with less effort, that means that that's going to actually cause deflation, right? Another thing is if you look at around the world, like China right now is like going balls to the wall with stimulus, and so you're going to see like cheaper imports coming into the country. But at the same time, you got also like a little bit of tariffs and stuff. But essentially, that boost in production outside the country could theoretically, like on a global level, cause more disinflation. You know, where if you can buy products cheaper overseas and bring them here, of course you're going to make good money. So that's another thing to consider. And one last thing is just if the total return in the stock market is not that great, you know, where you have low performance in terms of like total growth, then that's also something that's something to worry about. So, you know, in which case now you have to kind of stimulate the economy. So we'll see where everything goes. I'm just not, I just, I have to just be very cautious and just follow the bond market. That's what I always do. Bond market is going to give you the insight into like how you should somewhat
Right.
position yourself going
Yeah.
forward. Yeah. So have you, so this is Allstate, you know, the insurance company, Allstate. So
Mhm.
they have a preferred equity. They have a preferred shares right now that's currently yielding 6.8%. So on face value, it's actually I think about 7.25 or something like that. But the face value is never the only thing you look at. You also look at the yield that you're going to get. The good thing is if you bought this preferred equity, you would get currently, based on today's price, a 6.8% yield on this preferred equity. There are other things that happen with preferred equities that you really have to know. Like, okay, when you do get paid out, how is it getting paid out to you in like, and how does it impact you on the tax level? So there are some that are qualified and some that are not qualified. So if you look at, and this is like the convoluted thing, it's just, let me see,
Little Barry
preferred
White. I'm
equity.
qualified to satisfy you.
Uh, damn it, man! I have to find the data. But
But I have a question. I mean, so that was at the $27 price, right? Are you saying just because you want to lock in 7% yield that you would buy that, or but knowing that if they were to buy it back, you'd lose that $2 in value that
well,
you buy?
well, the good thing is it's not callable until 2029,
Yeah.
right? Or 2028, something like that. I have to find out. I have it in a spreadsheet. But basically, it's non-callable for the next 5 years.
Okay.
Right? So basically, the company can't just come and say like we're buying it back at par at 25. Like when you have call provisions in these like, you know, securities, that means that they can't just come into the market and buy it back. You know, essentially. So that's a good thing. So anyone who's chasing yield is going to be buying stuff like this. So let's say right now you're an
So you
endowment
buy
fund.
it, you get $1.81 or so per share. So
Mhm.
basically, you're saying, okay, within the first year, you're then getting a risk-free, 7% return-ish, around 7%, right? I know there's
Right.
percentage points off
Yeah.
there, but um, so basically, you're saying for the next 4 years after 2025 to 2029, you're just steadily pulling in 7%. So it's
Right.
basically like you're buying a bond and you have that callable value, unless you think Allstate's going to zero, which it's one of the premier insurance companies in the country.
Yeah.
You're probably safe.
Now, another good thing is that you can buy things that are trading below par, right? Below par stuff is great because if interest rates come down, people are going to be bidding it up. But then also the the underlying the underlying company, its business model ends up recovering, in which case now it becomes more secure. So I'll give you a good example of something like this VNOL. I actually spoke about this yesterday with the Patreon people. Uh, so if you look at this is Vornado cumulative preferred. Um, it's trading because preferred equity. This one is a 25
Par
preferred
value.
par value. So right now it's trading at 1791. Now, what's really good about this is that one, you're going to get a 5.4% yield on face value, right? So that means that right now you're actually going to get more than 5.4 for being in this. So you're going to get, I have to see how much the current rate
So it's a
is.
$1.35 and
Yeah.
dividend.
Yeah. So
And then
7.5,
divide by the 17, it's an 8%.
almost
So you go from
8% yield, right?
yeah, yeah.
Now, the benefit is not only are you going to get a 7.5% yield, but when this thing eventually gets back to par, right, which is 25, you're going to get that capital appreciation from 1791 to 25. So what does that equal to? That's let's see, let me just do the math real quick.
About a billion.
17.91 divided by 25. So that's you get almost a 30% return on that, you know, on the capital appreciation portion. So this way in the future, you could liquidate this at par, in which case you're going to get 30% plus all the dividends that you may have been collecting over time. The only thing is this one is not a qualified dividend, which means that you would have to pay taxes on it, as ordinary income. Whereas the Allstate one is qualified as far as I have to double check to make sure it is qualified, but you wouldn't have to pay taxes if you're in a preferential tax zone, So right now, if you look at qualified dividend rate, is actually much better. Let me just see right here. Blah, 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 blah. So right
So if
here.
you're a retiree, by the way, and you
Yeah.
less than 50 grand a year, this doesn't matter. But if you're somebody like Chris or me, it does matter because it can mean it could be the difference of paying an additional couple $1,000s a year, depending on how much money you have in taxes, depending on how much money you have in it.
Yeah. So this is the tax rate that you would be paying basically. So 0, 15, and 20,
63,000 now. We're moving up.
Yeah. For head of household is 63K. If you're jointly, it's about 94,000. So imagine right now you're a retiree, you have 2 million in the bank, right? And you're getting like 7.8%, so that's what, almost 160 grand a year, right? So the first 94,000, you would pay no taxes on that dividend. And then you would pay 15% on the balance after that, which is still really good if you think about it. So
I want to bring this up. So this gentleman's saying, oh, there's no maturity. That's okay. Do you think the Vornados could have want to be paying out, 5% forever or 5.4% forever on a $25 par value? Or do you think they're eventually going to buy that back and refinance whatever into, say, a debt or something of the like, right? I mean, it's interesting how sometimes people take certain things and they try to make it seem like it's worse than it really is.
And then you can always sell in the open market at 25 at par because some people they're going to be looking for 5.25% or 5.5% yield, especially if the federal funds rate and the banks are giving you 0, You
Yeah.
want that. You want that juicy yield, especially like I said. If you're a retiree, you have $1 million in the bank. You're trying to create a nice little income stream. This is what people are going to do. They're going to buy up preferred equities that are safer than buying the standard equity, put it into their portfolio, and chill in retirement.
Yep.
See, the thing is, right now, people have really short-term memories. So
Yep.
so yes, preferred has been callable since 2018. So it was also trading at par for the last 5 years. What does that tell you?
Yeah.
You can always sell in the open market at par. You don't need the company to redeem it, by the way. So that's the other thing that I guess this guy Azure Blue, I don't know what his deal is, man. He's always like trying to poke holes in the thing.
Yeah.
It's fine, but look, if you look at like VNOL, and let me just bring it up just as an education for.
I mean, it doesn't always have. You could always have a buyout. You could always have a lot of things like TellZ, for example.
Yep.
The Tellurian buyout. People are, printing money on that. You were telling people about that, and it's not exactly the same, but it's very comparable. You were telling people to buy at half price. It was like, I forget what it was, $10, $11, $12, and a lot of those people were able to sell at $23, $24.
Yeah.
And so, in this respect, I mean, in a declining rate environment, it's only going to help Vornado, right? A lot of the reasons why Vornado, Brookfield, all these came off of closer to par value is because the risk of bankruptcy went up and people were getting a little scared. So it's going to be the exact opposite.
Well, the thing is, look, you could have sold so many times at or near par, So first and foremost, none of what we're saying is advice. All right. Like, I don't want you giving foolish advice. So none of what we're saying is advice. Do your own research, do your own homework. All right. But then it's also kind of like disingenuous to say, please don't tell anyone that it's going to be called at par. And I'm not saying that it's going to be called at par, but the company has at its option the ability to call it back. All right. So that's what it is. The point is, you could always sell in the open market too. So the good thing about preferred equity versus something like a bond is that bonds traditionally are not as liquid. Whereas with Vornado, if it's trading at par about 25, you could just boom go into your brokerage, do a what is it called, like a sale, and call it a day, whether it be market or go to the what is that thing called, or do a God damn it,
limit order,
a fill or kill. Yeah.
Oh, fill or kill. Got it.
Yeah.
Ocean companies, preferred, paying monthlies. Yeah, I mean, I've done preferred in the past. I mean, for those people that are strictly looking for yield, right? And I think that's where you're talking about, Chris. I mean, you're talking about maybe growth is entering within 2025 is going to enter a little bit of a time where we've basically from the bottom of 2022 to now been able to enjoy kind of a free ride on a lot of these growth companies. And you're saying, one of two things. Not only are people going to be looking for yield as yields kind of get cut, so the free money that the savings account was making, your 5%, just for having it in a money market, is no longer going to be there within the next 12 to 18 months, that we've kind of started to get used to. I know I started to get used to. But you're also saying it's a nice place to just hide money while you wait for some of this stuff to play out. And so, we're not saying it's for everybody, right? But specifically for those that are maybe a little bit older and they don't want to necessarily focus on the growth aspect of their portfolio. They want to focus on a dividend side of their portfolio, income side of their portfolio. It's something to consider, right? It's not ever about Chris and I trying to push things on anybody, right? It's everybody just trying to get an education about the different opportunities that are out there. You taking the 5 things that we always talk about, and I know I preach this heavily: objective, time horizon, risk tolerance, how much capital contribution you want to put in, as well as how active or passive you want to be in your portfolio. And it's taking pods like this to say, that's interesting. I never thought about it before, but that doesn't meet any of my objectives. So while it's nice to know and put a feather in my cap, I'm not going to use it. Or you could have somebody out there that's like a 65-year-old man that's like, oh, that's really cool. I don't want to risk all my money investing in something like Nvidia that could drop to $60 overnight or over the course of a couple weeks. Let me store my capital in something like a PFF, which is an iShares preferred fund. And of course, I always recommend anybody, if they invest in some sort of ETF, to read a prospectus, or any stock even, um, to read a prospectus, because, like Chris said, different things can have different tax implications, and that could screw you over, right? You might end up having to deal with an accountant or something, and having to talk their ear off and pay them a shit ton of money just to understand your taxes, and that's never fun either. So, yeah.
Yeah. Well, look, I'm not gonna like go into too much with Vornado. I think Vornado is going to be fine. They have great assets. Yes, they're commercial real estate, but they're trophy level assets. The operating cash flow is still positive, so they can keep going. And by the way, the dividend distribution with preferred equity accumulates if they do pause it. They haven't paused it; they're still paying it out. So, once again, I don't see the point that this guy is making. And yes, it's $9 billion in debt, but what do you think happens to the debt when interest rates come down? It becomes easier to service, which means their operating cash flow, once again, like we said literally like 30 minutes ago, that it's going to go from debt holders because they'll be able to pay down debt over time, right? And their balance sheet will recover. So like I said, I personally think that is where we need to look for the alpha. And maybe the Wall Street guy with his 40 years is, out here trying to be on a YouTube channel with a couple of guys that are non-Wall Street people. Like, I always find it that, why don't you go out also at negative return on equity? Again, they're junk rated, have suspended their distribution. Dude, that is absolutely true, because right now the cost of capital is, why am I arguing with someone on the comments? Yeah, that's what happens. Federal funds rate went up significantly, which means debt is harder for them to service with the current cash flows. But if the bond market is telling you that future interest rates are going to go down, the debt is going to be easier to service, in which case now more money is going to go from debt holders getting interest payments to equity holders, and preferred equity sits above regular common. So now you're going to get paid out higher. That is why if you think Vornado was so terrible, dude, it went from $11 to $17. That is how you make money in this market. You figure out what other people are not looking at. You don't just sit in the back and be like, oh, I'm scared that this is a junk rated bond. Bro, there's a ton of companies that are junk rated that people are buying in the open market right now.
Yeah.
Okay.
I mean, Transocean, for example, was always rated as junk rated. Had you had bought their debt, you would have fucking printed money, right? And it all goes back to, I mean, it might be junk rated, and that's a comparison between, say, other companies, right? You're comparing against Apple's pristine balance sheet or Johnson & Johnson's pristine balance sheet versus somebody else's. But there's so many ways to financially engineer yourself out of a junk bond rating, and then eventually get re-rated and make a crap ton of money, right? But it's all about risk versus reward, right? Do you want to take on that risk and get a 5x over the course of, say, 2 or so years, which would massively outpace the market? That's risky, right? Most of the times you're not going to find things that are worth 4 or 5x unless they have a little bit of hair on it, or a lot of hair on it in the case of Transocean. But it just goes into, is that something that you're worth, wanting to potentially fight for? And in the meantime, get, a 20% yield or whatever it was not too long ago. I know we talked about that in one of our previous Cashflow Chronicles episodes in season 1. But I mean, it doesn't have to be Vornado. You could do it on SL Green. SL Green has preferred shares. So I mean, it's all dependent upon who and what you're looking for.
Yeah, another thing to look at also, look at this, like from a balance sheet perspective. Some of this you can say that, it may not be priced right, but right now their total assets is about 16.2 billion for Vornado, right? And the total liabilities is 9.7. Okay. Now, what does this mean? That means that there's almost $6.4 billion of equity ahead ahead. So now with preferred equity, there's only about 1.18 billion. So what happens is, let's say for some reason Vornado says, okay, we're going to go bankrupt, right? They just say we'll declare bankruptcy. That means that the first payouts are going to be here in the long-term debt people. The first lien, second lien, they're going to get paid out. Then unsecured creditors are going to get paid out. So all of this stuff will get paid. From the 16 billion, 8 billion will go to them. Then there's another $6 billion of additional equity that's left to pay the preferred equity holders right here, right? So imagine right now, it's almost like a bucket. This bucket has a ton of water in it, and all it's going to do is just pour the water. And this is under the guise that they declare bankruptcy, which by all means it's not happening. Their cash flows are actually doing okay, and they're actually doing what is that thing called, better in terms of total return. So right now you're starting to see their total revenue is basically stabilized. The only thing that's killing them right now is their interest expense, which has gone up. But once again, as interest rates come down, Vornado will be able to issue debt at a cheaper price, and it's going to go the other way. The other thing is leasing rates in New York City, because this guy says he's from Wall Street. You can already see that leasing rates are starting to recover. And as leasing rates recover and they go up in value, and there's more people, utilizing the spaces in Vornado's buildings, which are, by the way, Class A buildings in New York City, you're going to get more rental income. So your interest is going to go down. Your rental income is going to go up. Your assets are naturally going to go up in value because, once again, there's no land in New York City that's like going downhill, So a lot of this stuff it happens in the background. But essentially, I don't think Vornado is going anywhere. I think eventually it's going to recover. It's going to be a few years before it happens, but the preferred equity is where you want to hang out. You don't have to deal with the gyrations as much in the regular common equity, and the risk in common equity is actually higher than the preferred equity. So preferred equity is where I would be in it,
Yeah, man.
Yeah.
Trying to think of them. Looking at a few other ones, seeing if there's any ones that are there. But I thought it was interesting. I never seen the SL Green preferreds before, so it's pretty cool to be able to see.
Yeah.
Trying to think, man. I mean, I guess the question to end on, and appreciate the 135 of you that are still watching, the one of you that is watching on Twitch. What do you think? Do you think that this is going to do, meaning the market specifically, macroeconomic, do you think this is going to persist throughout the month of September? Do you think today rather was rather just surprise after last week's sort of hit with the CPI numbers coming in as they did, and the culmination of knowing that within the next, I guess, week and a half, 2 weeks, we're actually on the precipice of getting interest rate cuts? Do you think the market is really just pulling back a little bit and getting, I guess, itself ready? Or do you think that, I don't know, what do you think of this current environment? I'm kind of sitting here like, I don't know which way or the other we're going to go, right? So I'm kind of at a loss for words.
I'm in the same boat as you are right now. Like, I don't know what's going to happen, mainly because of the election. Things can go either way, so we'll see what happens. If the election ends up coming out Trump, the market might gyrate one way. If it comes out Kamala Harris, it might gyrate another way. You just don't know, man. You just don't know. So the best thing to do when you don't know is not do anything, So, yeah.
But that's the thing. I think that's something to say. I mean, if you're kind of feeling a little bit uncertain, I know I've raised a little bit of capital personally on my end. One of the companies that I write cover calls on got called away, and actually I thought it was at a reasonable price. And so my Next Era Energy, I'm trying to contemplate whether or not I want to take that capital and write puts on it, or if I'm just going to sit on some of that capital. I do have some small debts here and there that I might just liquidate that could help increase cash flow. Like, for example, a lot of people always talk about not paying stuff off early, but if you think about my car payment, it's a couple $100 a month. If I just pay $4,000 or $5,000 or whatever, get that car payment knocked out, Next thing you know, I'm making a couple $100 extra a month. It allows me to breathe a little bit easier, right? So it might have that sleep well at night sort of factor. It could be one of those things where you're just sitting on cash, or you're stacking up cash flow and you're waiting for something to kind of come down the pipeline that is super cheap. And I think anytime that there's some sort of massive change within the market, whether that's an election, whether it's interest rate cuts, there's going to be some sort of opportunity. And that's the nice thing that's beautiful about the stock market, is that there's always an opportunity somewhere, even though that sounds like something that Jim fucking Cramer would say. But there's always an opportunity somewhere. And, if you have cash on hand, you could take advantage of it. And it might not necessarily be when the markets are at all-time lows. I mean, look at Celsius right now. The majority of the market's at all-time highs, within a spitting distance of it at least. But Celsius is down, 65%. And if that's something that you think could be a good long-term buy, I'm not saying it is, not saying it isn't, but could be something that you potentially look at. And the market gives you those opportunities sometimes without you even kind of recognizing it. Like, shit, what was it? Facebook or Meta back, in 2022, when you and I think it was Vitali bought it up a crap ton, right? While I was being dumb buying up Google and Amazon, I should have been buying up Meta instead. But the market gives you opportunities sometimes for no good reason, and sometimes you just have to be like, this seems out of place. And it goes back to what you were talking about with the preferred equity, right? That looks like easy candy. Like the Vornado, it's like, that's going to go back to par value, in my opinion. And you don't necessarily have to wait for them to call it. Even if you just wanted to play it from $17 to $20 or $21, I have a feeling that as you get some of these interest rate cuts, and if the interest rate cuts happen as fast as you're kind of showing with the overnight rates compared to the triple B bond yields, you could see that $17 to $20 bump within a matter of a week or two. It really just depends on how aggressive these guys get. I mean, they could come off the bat this upcoming, I guess it's 2 weeks from now. I guess it's exactly 2 weeks from now, right? When they actually release it. They could come out of the batting cages swinging with a 50 basis point cut. And next thing you know, you're like, oh, shit.
Yeah, I doubt that. I don't think 50 basis.
You don't think so? But if they did, I mean, imagine what it would do to some of those.
The GDP print is the GDP print is too high for them to do that. Like 3% on GDP.
3% is too high.
Yeah. Let me say the GDP is like, they have to. The problem is, if GDP came out weaker, then maybe there was a shot at that. But I don't think that that's necessarily the case. The other thing is, that's why everyone's a little bit kind of unsure what's going to come out in the jobs report, because the jobs report, if it comes out super weak, that means that we might get 2 cuts. If it, but that also means that we might be headed into a recession. Versus if the jobs report comes out okay, that means that, hey, we're doing fine, in which case now we're probably in the soft landing zone. So everyone is worried about soft landing versus like hard landing. And so I think that is going to cause a little bit of market gyrations here and there. But for me, long term, I would say that there's a possibility for small caps to do well over the next couple of years, mainly because their valuations are at a lower point, and a lot of them have floating rate debt, and then also they are heavily indebted, which means that any reduction in debt is going to, interest for them is going to end up being beneficial for them long term. So, that's kind of where you want to position yourself in the long term. So if you go to, like I said, this is where I go back to the cruise lines. The cruise lines are cash flow heavy businesses that have a ton of depreciation on their books, which means that now all they have to do is just kind of pause their new build orders. And now they have a ton of cash flow that they can use to pay down debt, and their debt is becoming cheaper to service, which means all of that return is going to go back into the equity markets, for them. So the share prices will go up while that happens. So, yeah.
Yeah. Cool. Yeah, I'm with you. I don't know what the heck is going to happen. What I do know is I think it's going to be a range of uncertainty. And I'm looking for what's going to happen. I think, to me, we're going to be in this world of of price discovery until there's going to be some sort of until there's going to be more certainty. And I think it's going to be volatile between now and the next, I would say at least at a minimum 2 weeks, but probably maybe until the election. Even if we only do get the 25 basis point hike or cut, I think until the election it's going to be uncertain, and even more so if some of this back and forth on the political arena continues to occur, and if like a debate continues to get delayed and stuff like that, I think it's only going to exacerbate the volatility within the markets. And so I don't think it's a bad time to keep a little bit of cash on hand, because I think from this there will be some small opportunities that people could take advantage of that would likely outsize return the S&P 500. And that's always kind of our goal, is to kind of look for those opportunities, at least present them in a timely manner. Whether or not we actually end up getting to take advantage of it is a different story.
Yep.
Cool. All right, my man. Well, I am back in the country.
How was Mexico?
Mexico was a good time, man. Nice and relaxing. I will say I'm more of like a siesta and like keep calm kind of guy. I'm not like I either have two modes. I either like to be like driving around independently, getting lost, and seeing new things, or like relaxing and on a siesta. But I think it was one of those ones where I just needed to get a nice little relaxation in. So it was nice to be able to take advantage of that.
Nice.
Yeah. What was I going to say? Yeah, man. When Thursday, you think you'd be good for that? Play it by ear?
Yeah. Actually, I'd probably have to skip it because I'm actually flying out to New York. Okay. I'm getting a nice little check from my closing. I only got the deal done. I already know where I'm going to park all that cash, and basically
give it to me.
Bro,
I hate when people make that joke. What's that?
I said, if anything, I need a loan from you.
I know.
I'm just going to park it into some fixed income investments that I want to do. Basically just give myself a little bit of return on the side, give myself some cash flow. My goal is to buy a house. But the thing is, I have a good amount of money that's liquid. It's not like liquid as in just cash. I always invest my money, but it's in instruments that are pretty liquid. But the goal is to get to the point where the house is being paid by the investments. And so I'm living for free, basically. And I don't necessarily have to worry about other things. Not to mention, I'll talk to you about it, but then you know how I was talking to you about the SB lock. So I want to kind of eventually do some SB lock, in which case now interest rates come down, the value of the securities go up, and at the same time, the income that's coming in is a fixed income that's coming in that's helping me pay. So it's almost like I wouldn't call it arbitrage because it's not an arbitrage, but it's a way to play the thing. So I could buy a nice house, get a deduction on my taxes, because right now I don't have. The place that I'm selling now was my mortgage interest, and part of my my taxes were deductible, so that was good. Now I don't have that anymore, so I need to buy some property.
Yeah, man, I'm looking forward to the mortgage interest from the new place that we bought in May. That'll be fun because that's a lot of interest because it's a pretty big mortgage. So, but even this one that at my house, I didn't have that last year. I only had it for like 2 months, so I didn't really get a lot from that. So it'll be nice to get a little bit more. But what was I going to say? I think a step in the right direction for me, talking about like SB locks and stuff of the like. So not exactly on that realm, but I have slowly started to do away with my normal checking account, and I'm investing direct depositing more and more directly into my brokerage account. And I'm starting to, like I said, I was trying to like get rid of some of those monthly payments of some of that stuff. Every time I get rid of one of those monthly payments, I go into my employer and I say, whatever I was paying on that, right, put that into my my brokerage. And so eventually my hope is that really I just have all my money going into the brokerage, and I just operate out of that. And whenever I need to pay bills, I'll just pay it out of my brokerage account. So we'll see what ends up happening with that. I'll probably always still have a separate account just for safety, right? So I'll probably always have a checking account just to be able to pay
The
bills or something like
12-month
that.
safety, whatever it's called, you know.
Yeah, but so I'll probably always have like 2 months expenses in there or something like that, and pull out, you know, my normal expenses, whether it's 3 or 4 grand a month, just so I have you know, that kind of coming in there. And if there's ever excess, I could just put it back. But it'll be nice because I think that'll supercharge. Because I think what ends up happening is I end up doing stupid shit sometimes, and I'll just like buy something for $1,000 here, $1,000 there. But if it's in my brokerage account, I'll end up being stupid and buying more stock, which most of the time holds its value, right? So anyway,
unless we get a massive correction, then it's like no.
Exactly. But so I was happy, you know, it took a little bit more of a step in that direction because I was saving a lot to a Amex personal savings, and I was like, that's nice, but I was like, that personal savings gets just as good my brokerage account money market gets just as good. So I was like, why am I doing a personal savings account with Amex if I didn't get just as good of an interest rate yield with the Fidelity brokerage? It just doesn't make sense. So anyway, I was like, let me eliminate a step, because normally what I end up doing is get a couple $1,000s in that personal savings, transfer to my checking, then transfer to my brokerage. I'm like, I just need to get rid of that step, you know? Didn't make any sense. So simplification.
Yep.
Cool. All right, my man. Well, I'll keep in touch. Maybe we could do an ad hoc off stream, not off stream, but ad hoc at a different day.
All right, sounds good.
You're the man. Thank you all for the 127 of you and the one individual on Twitch. Much fun as always. And let's hit us with the outro.
Greed is good.
The stock is going to go up, down, sideways, or in fucking circles. It's all a fugazi.
Sell it all.
Greed is good.
Huge upside potential, upwards of $60,000.